Q4 2025 results are in, and one thing's clear, at the end of the year, the market tight.
Sales rose year over year, but the big wrinkle is that inventory finally fell annually.
And when sales rise and inventory falls, that's when you see the pace pick up. And that's what we felt on the ground in Q4. Welcome back to the Real Talk NYC podcast with John and Jonathan.
Hello, Mr. Collin.
Hello, sir. My partner we're in our 20th year together, if you can believe that I'm that old. And today we're talking about...
You were a child when we started working together.
Just a baby.
Oh,
and today we're going to talk about the Q4 Manhattan market stats.
Exactly. And when we talk about the sold and closed deals for Q4, just a reminder that in Manhattan, from a contract to closing, there's a lag of about 60, 90 days. And so we're really talking about sales that happened in the fall of 2025.
Yeah. So, as always, let's start talking about mortgage rates. So, the report notes that 30-year mortgage rates did fall a little bit to 6.15% by the end of Q4 2025.
Correct. And it also points out that rates declined by more than 60 basis points since early summer, which tends to affect the lower end of the market the most.
Right. Not necessarily cheap money, historically speaking, still good rates. But offering still that stability that we talked about last time is the main point, and that stability definitely remained in the mortgage side. Next, we start talking about closed sales. So closed sales, we had a little over 2,600 closed sales in Q4. Again, those are more than likely Q3 contract signings, but that's up 5.4% year over year, and down 16.7% from Q3, which is fairly typical because of seasonality.
And the report also goes further in saying that this is the fourth consecutive quarter of rising sales year over year in Manhattan. So that's that market's moving.
Yeah, it's a good, stable sign. And worth noting, cash deals, which are always very prevalent in our market, was over 64% in the deals that got signed up. So that's actually a little higher. Usually we see somewhere closer to 55, 60%. Mm-hmm. So,
and then in the lower priced co-ops, we saw 57% of the buyers were paying cash and 74.4% for condos. Okay, so let's jump into inventory. Inventory, very interesting. We saw inventory end the year with 5,887 listings, down 23.9% from Q3 and 4.4% decrease year over year.
And that annual decline is the first time Q1 of last year versus Q1 of this year, Q2 of last year versus this year, et cetera. This is the first decline in 4 quarters.
Correct. So translation, there's less choice, faster decision making, and bottom line, there's just less options overall.
Staying on the inventory note, we always talk about months of supply. So months of supply / absorption rate dropped to 6.7 months in Q4. So that's that tightening that we're talking about, the pullback in the inventory. And we'll talk about takeaways and such of what that was due to, what we think it was due to. But that's down from 7.3 in Q3 of last year, and down from 7.4 in Q4 of 2024.
And the report also talks about the pace of which the apartments were going to contract. So it says that the months of supply was 9.5%. It was moving faster, 9.5% versus last year, and quicker than the decade average of 7.6 months. So the market had a very robust last quarter.
Yeah. Yeah, and days on the market also improved to 74 days, down from 77. So, and that decade average of 7.6 months is a number to hold on to because it's a lot more data points and such, and we're almost a month short of that. So as that number comes down, that absorption rate, that's what increases activity typically.
So now let's talk about negotiability. The average listing discount came in at 5.1% versus 6.2% in Q3, which again, to your point, talks about a tightening market.
Yeah, especially when you compare it to last year. Last year in Q4, we had 9.2% negotiability. So that's buyers and sellers' expectations coming in line. Buyers willing to transact a little bit more readily, and then sellers' expectations, i.e., asking prices are perhaps coming more in line. So them seeing eye to eye.
Right. And property type, we saw co-op negotiability at 4% and condo 5.9%. So
Yep.
co-ops were a little tighter.
Yeah, so buyers there's still negotiability out there, which is typical. That we always talk about 5% is, pretty much
Average.
the standard
Right.
in our market. So,
So it's good that sellers are coming down in their pricing. They're coming down. They're coming to the market.
Yeah,
Many
buyers
sellers are. There are
are
some sellers that are still highly ambitious.
and as we talked about last quarter, that's the stability in the market, stability in interest rates, and giving buyers confidence to make purchases.
Right. So to summarize, Q3 we saw greater volume. Q4 tightened quickly due to lesser inventory, and negotiability was less as well.
Yeah, exactly. And while prices held up year over year, so you look at median prices, average prices, all those metrics, they stayed fairly flat. But the key shift is leverage moving back towards sellers because supply dropped.
Okay, so wrapping it all up, if we were to sum up the Q4 in one word, what would it be for you?
I would say stabilization. Stabilization in interest rates. Of course, we had inventory come down a bit, but negotiability, very, very typical amount of negotiability, so stability. How about you, John?
I would say tightening. So the reason I say that is that everything is based on supply and demand when we look at Manhattan real estate. So if we have fewer apartments on the market and we have a stronger demand, a demand that's gotten used to, interest rates in the mid-6 range, then we're going to see a stable market. We're going to see, seasonal bidding wars depending on the price point or the real estate in question. But then we're going to see less negotiability with more buyers in the market, but lesser homes, less optionality. So,
and remember, when inventory comes down, what did we have at the end of the last year, which we talked about in our last quarterly podcast? We talked about Mamdani coming into mayor, if he won the election. Now he won the election, which could have slowed some inventory coming on the market, and we could see that rebound, those inventory levels rebound in the spring, where people are like, because what we've talked about with a lot of our clients, anybody that we're meeting, is there was an emotional effect to Mamdani. And the idea, and we started seeing that effect as soon as he won the primary, and we talked about it in the Q3 podcast. In reality, how is that going to affect our market? And the one thing I'll say about New York City and New York City sellers is that they only wait for so long. Like, it only holds for so long, and then the dam breaks, and then everybody's like, all right, well, the world's not ending. Which I guarantee you, Mamdani is not going to, be able to do a lot of the things, if that's what you're concerned about, and that's what people have expressed, is all of this, the things, his policies that he ran on. But it's not as simple as him getting in there and just flipping a switch, and now and now all of these things come into play. So that's going to take a long time. It's going to take a lot of hurdles to get over the different his different platforms and such that he's aiming for, policies that he's aiming for. So, but what we do always see, whether it's been a shift in the mortgage rates or COVID or whatever. Well, not necessarily COVID. That was a shift that happened because of reality. We couldn't sell anything. We couldn't do anything. But when there's something like political or something, there's always an emotional response to it. We don't know how long are those legs to that emotional response. Is that something that's going to go away in the next quarter, in Q1 that we're starting now? Or is it something that's going to last a little bit longer, and time will tell? But it will be a short-term effect on our market, in my opinion. My humble opinion.
I think even more importantly than who's at power is that we're reporting on the numbers where they are now, and coming into 2026 with 5,800 and change units on the market. You and I both know that that's a lower amount of inventory versus on average 7 to 9,000 units on the market. So is that seasonality? Are sellers waiting to put their apartments on the market? It's the beginning of the year. We're listing more homes on the market, which is good for the consumer. And
what aren't we hearing from those sellers is, oh, the market's going to crash because of
we're not
Mamdani.
hearing that at all.
Let's price the apartment 10% below what the last person got.
But one thing that we are
reality.
seeing, though, is we are seeing some apprehension by some sellers, but in other sellers who are responding to offers which may be a little lower than what they had originally wanted to sell their home for, but they need to sell the home for start a new chapter in their lives. They're moving up. They're moving out of the city. So we have a very stable market, like you were saying.
Yeah.
And I think for the forecast for 2026, barring any kind of major geopolitical problem or anything major in our city, is that
Possible
it's Manhattan.
war, like who knows? You know?
Major Manhattan's here to stay. It always has been, always will.
Yeah.
And I think I'm going to be staying in 2026. What about you? Are you be staying?
I'm sticking around.
I'm staying with you.
Yeah.
Year 20. We're celebrating our 20th this year.
I know, in September.
20 anniversary, 20 years together.
Yeah, the long story short is apartments are still selling. Buyers are still buying. Our business, we're very fortunate to have a very good mix of where our deals land, whether buyer, seller, different price points, et cetera. We're seeing activity across the board with our buyers and with our sellers. And hopefully, that continues throughout this year. But as always, time will tell. The number one historical fact is that New York City always remains a powerhouse.
Always. So that's a good place for us to end. Thank you so much for tuning in. Always a great honor to talk to you all. And for now, be healthy, safe, and
remain in gratitude. We'll talk to you next time.
See you next time.